We are seeing things we have not seen
Finally,
ever.
one thing that you have to talk about is, the CEO, Mark Ruffler, ended this really abbreviated 12-minute call, no Q&A.
The bond market that's sending all these conflicting signals. I myself can't make what to think of what's going on in these parts of the bond market that we're not used to look at.
Think about what you think about. Say it again, and that's a fact. Think about what you think about. Folks, look.
Welcome to It's Contrarian channel. From today onwards, we have a bunch of topics to discuss, and I've got a good one for you today. The last CPI report pointed out that the inflation fell for the 8th straight month in Feb. But if we look at Treasury yield, it's going up from March 14th since the CPI reports came in.
That are higher given the weaker than expected inflation data that was out there. That would make you think that the Fed is getting near the end of the rate hikes, and maybe as a result, yields would come back down a little. What happened?
So two things happened. One is core inflation was not weaker than expected at 5.6%, and that's the one to look at. And second, flying under the radar screen are survey measures of inflation. You had the New York Fed last week showing that inflation expectations for this year have gone up a full 0.5 percentage point.
Despite inflation going down, inflation expectations are not going down, and it is going up.
That inflation is going to be sticky at around 4 to 5%. And that's what's been reflected in the 2-year that has traded back up to 4.14 and higher expectations of a 25 basis points hike at the beginning of May.
Big tech earnings are expected this week, and I was in market position for this.
Will it be 70s? Will they be beating like the financials or not?
Yeah, I mean, if all of the price cuts, if all of the layoffs and things that they've done improve margins, I think there's a shot to stay at 77%, even with some of the tech spending slowing. But
that's too bullish for the tech, considering the uncertainty in the bonds market. Let's take a look at how First Republic Bank reported its earnings. FRC reported 40% drop in its deposits, $104.5 billion in Q1.
What we saw today was really how dire the situation was for First Republic. You mentioned the $100 billion in deposit drain. That's what it would have been without the $30 billion injected from JP Morgan Chase and others. So that was that was pretty bad on its own, because that's not dissimilar from the scope of bank runs at SVB, at Signature Bank. The picture, the update they gave today is it seems to have stabilized. They've only lost 1.7% of their deposits in the last 3 weeks, which sounds like good news.
Initially, this stock reacted by dropping about 8%. However, it dropped over 21% when there was no Q&A at the end of the earnings call.
Talking about cutting up to a quarter of their employees. They're talking about cutting their office space and drastically cutting back on their loan book. And finally, one thing that you have to talk about is, the CEO, Mark Ruffler, ended this really abbreviated 12-minute call, no Q&A. He ended it with the sort of, the idea that they're still looking for strategic options here, which is Wall Street speak, as you know, we're looking either for a capital raise or we're looking to sell the place.
With that said, we really cannot be that bullish based on just financial results alone, because First Republic was expected to beat in terms of deposits. However, that did not happen. Now let's take a look at the inflation cycle and how that impacts the existing market situation. Now let's take a look at the inflation cycle. In the beginning of 2022, we felt the impact of high inflation with the high oil prices and natural gas prices. Oil went above $100 and natural gas about $9. We also saw that some of the food prices went up, especially orange juice, eggs. And then we saw the impact in the rent, especially in big cities like New York. The prices went unaffordable for many middle-class people. The impact in services, wages, earnings in market were not as big as the impact in energy, that is natural gas and crude oil, shooting about like 100%. And food and rents, eggs prices have increased about 70%. Rents have not increased as much as Airbnb and hotels. Both have almost doubled in some parts of the city.
If you look at how inflation has migrated from a few goods, food and energy, up to the whole goods complex, and now to the service complex, and we're starting to see it in wages. People should follow the Atlanta Fed wage tracker. That's up around 6%. So if you look at what has happened to the inflation dynamics, it's now embedded in the service sector and it's starting to impact wages. And that's what happens when the Fed is late, is that inflation goes from things that are interest rate sensitive to things that are less interest rate sensitive.
Meaning even if they hike rates further, it's not going to have that much impact?
You need to go higher and for longer, and therefore you incur two risks that we've talked about. One is to the real economy, and the other one is to the financial system.
Previously, we saw inflation dropping for the 8th straight month. So, what really dropped, and how did we manage the inflation right now? As such, the crude oil prices went down with the usage of strategic petroleum reserve. For the natural gas, we got lucky this time with the climate change. We had a warm winter all over North America and Europe. Does this guarantee a price stability for crude oil and natural gas for the future? I don't think so. For the other areas, there was no real management that was done, and the prices went down with the fear of a recession. However, if the Fed decides to pause the interest rate hikes or decides to cut down the interest rates as what the market expects in terms of the equity market, these fear that was causing the price reduction in food and a little bit of rents and services, all of them is not valid anymore. So all of them will start going up again. So this is not a bullish case for the market right now. Anything that goes up will come down very soon. Now let's take a look at how delusional people are.
Well, there's three scenarios here. Pause, and then you pause. You wait through the rest of this year. You pause, and then maybe you cut. Or you pause, and then maybe you have to start hiking again.
We live in an economy that's supply pressured for the next few years. So I do not see inflation going down quickly. I do not see interest rate going down quickly. But those who simply extrapolate the past argue that this will happen.
Now let's take a look at how the current situation is so similar to 2008. As pointed out by Northman Trader, when they intervened with Bear Stearns in 2008, very similar to what SVG is this year, the SPX rallied about 14.5% and the VIX got crushed about 50%, which is almost the same in this year. 3 months after Bear Stearns, FDIC had to intervene again with IndyMac Bank, and then 3 months later, the collapse of Fannie Mae and Freddie Mac along with Lehman Brothers bankruptcy pushed the market nearly 50% down.
We are seeing things we have not seen ever or for a long time. I'll give you two examples. 3 months spread relative to 1 month at levels we haven't seen, astronomical levels. The 5-year CDS, credit default swap, is back over 50 basis points. We haven't seen that in the last 10 years. So the equity market actually is calming, is comforting. It is the bond market that's sending all these conflicting signals. I myself can't make what to think of what's going on in these parts of the bond market that we're not used to look at.
And that makes you want to do what with investments at this point?
It just reflects, I think the bond market recognizes and has embraced that there's a lot of uncertainty and that you've got to factor that in. The equity market is talking less uncertainty, and I just worry that you don't want to commit fully to this equity market until you figure out the things that we don't.
So given that understanding, let's take a look at the charts. S&P 500 4-hour charts looks bullish, especially with the MACD crossover happening. Looks like a bull trap for me. It's the same with QQQ 4-hour chart. MACD looks bullish. Uvxy is looking more in a consolidation pattern. So far, our original trade with Uvxy or UVX is at a loss. But given the uncertainty in the bonds market as compared to the equities market, the VIX will react very soon and we should be able to make a huge profit in this trade. Let's wait and see. So I also want to touch upon Alibaba, the Chinese company. So it's at $86 approximately, and it is almost at 30% drop from its recent highs. And it's the same with Baidu, which is the Google of China, and it's dropped about $150 to 122 now. So the China story, where they mentioned that it's about 4.5% growth in GDP, but the stock market is reacting negatively as we see it. Look at KWEB, that has gone down to 27.66, all the way from about $37. So the China growth story is not really happening, at least with respect to the stock markets. The CBOE equity put call ratio is lower at 0.57 for this week, and this shows the laid back attitude among the investors. And this is the right time where the market makers might do a short pullback. And if you want to be stable, as I talked about in the last week, let's go with buying a put option so that your portfolio can be in balance in case if there's a sharp pullback in the market. Or alternatively, this trade of the week that I explained, that is to buy anything with respect to VIX related components, VXX, UVXY, VUVIX. With this, we have come to the end of this video. Thank you for watching so far. And if you like these videos, please write your comments and like this video and subscribe to my channel. This will keep me motivated to doing more videos of this nature. Thank you very much, and I'll see you tomorrow with my next video.